Imagine waking up on a Monday morning, opening your phone, and feeling that subtle but unmistakable sense that something is off. Futures are flashing red, headlines feel unusually aggressive, and the tone across financial media has shifted from calm confidence to nervous speculation. This isn't just another rough trading day. This is the kind of morning where the market doesn't drift lower, it lurches. And at the center of this sudden panic sits a name most reported to be untouchable, JP Morgan. Today's story isn't about a single stock dropping or a bad earnings call. It's about a system showing stress and a giant that may have finally lost its grip on the narrative, on the market, and possibly on control itself. For years, JP Morgan has been portrayed as the ultimate fortress bank, the institution that survived crises better than anyone else, the bank that regulators trust, the firm that steps in when everyone else is collapsing. When things go wrong, JP Morgan is usually the solution, not the problem. That reputation didn't appear overnight. It was built through the 2008 financial crisis, reinforced during the COVID crash, and polished again as regional banks fell apart while JP Morgan appeared stronger than ever. But markets don't care about reputations forever. They care about cracks. And once those cracks start to show, fear spreads faster than facts. What we're witnessing now is not a sudden collapse, but something far more dangerous. A slow realization that the tools that once worked may no longer be enough. Over the past several weeks, pressure has been quietly building beneath the surface. Bond markets have been acting strange. Liquidity has felt thinner than it should. Volatility has been creeping back into places that were supposed to be stable. And while retail investors were distracted by rallies and memes, institutional money was repositioning, hedging, and in some cases, pulling back entirely. Monday didn't create the panic. Monday revealed it. The first sign something was wrong came before the opening bell. Futures weren't just down, they were unstable. Sharp drops followed by weak bounces, signaling uncertainty rather than simple profit-taking. This is important because uncertainty is what terrifies markets the most. A clear sell-off can be managed. Confusion cannot. As cash rushed into short-term safety, yields began moving in ways that contradicted the usual playbook. This is where JP Morgan's role becomes critical. Because when markets behave irrationally, it's usually the big banks that step in to stabilize flows. This time, the stabilization didn't happen. Instead of calming markets, commentary coming from major financial institutions felt defensive. Language shifted. Words like contained and manageable started appearing more frequently, which historically has been a red flag. Whenever institutions feel the need to reassure everyone that nothing is wrong, it's usually because something is. JP Morgan's positioning in derivatives, treasuries, and global liquidity channels means that when stress hits, they feel it almost instantly. And when they stop sounding confident, people listen. At the core of this issue is control. Not control in a dramatic movie-style sense, but control over expectations, over liquidity, and over confidence. JP Morgan has long been one of the main architects of market psychology. When they signal calm, markets calm down. When they step in, others follow. But now, markets are starting to move faster than the messaging. Information is spreading instantly. Algorithms react before humans can respond. And by the time reassurances are issued, prices have already adjusted. That gap between action and narrative is where panic is born. Monday's panic wasn't just about JP Morgan stock or bank stocks in general. It was broader. Credit spreads widened. Financial ETFs saw unusual volume. Options activity spiked aggressively, especially on the downside. These are not the actions of emotional retail traders. These are institutional moves. Smart money doesn't panic loudly. It exits quietly, hedges aggressively, and leaves clues behind. Those clues were everywhere, and the market noticed. Another major factor fueling this tension is leverage. For years, low interest rates encouraged risk-taking at every level. Hedge funds, private equity firms, corporations, and even governments loaded up on cheap debt. JP Morgan, as one of the largest facilitators of global finance, sits right in the middle of that leverage web. When conditions are good, leverage amplifies gains. When conditions tighten, leverage becomes a trap. Rising yields, persistent inflation, and slowing growth have created an environment where that trap is starting to snap shut. The concern isn't that JP Morgan is insolvent. That's not the story. The concern is that even the strongest institutions are being forced to react instead of lead. When control shifts from proactive management to reactive defense, markets sense it immediately. That's when volatility feeds on itself. Margin calls increase, liquidity dries up, forced selling begins, and suddenly, what looked like a manageable situation becomes a cascade. Monday's price action reflected that fear. Sharp drops, followed by weak recoveries, suggested that buyers were hesitant. Everyone was waiting for someone else to step in first. Traditionally, that someone has been JP Morgan and its peers. But if those players are busy protecting their own balance sheets, the backstop disappears. And without a backstop, even small shocks feel enormous. Adding fuel to the fire is the broader macro environment. Central banks are no longer rushing to rescue markets at the first sign of trouble. Inflation has tied their hands. Rate cuts are no longer guaranteed. Liquidity injections come with consequences now. This removes one of the most powerful safety nets that banks and investors have relied on for over a decade. JP Morgan has navigated crises with the assumption that central banks would always step in. That assumption is now being tested. Public confidence is another fragile component. Social media, alternative media, and independent analysts are questioning narratives faster than institutions can respond. The idea that too big to fail equals too strong to worry about is being challenged. Every unexplained move, every vague statement, every delayed response feeds speculation. Markets are psychological ecosystems, and once trust erodes, it's incredibly difficult to rebuild. As Monday progressed, the panic didn't explode, but it didn't fade either. That's the most unsettling part. True crashes are violent and obvious. Structural shifts are quiet and persistent. The market didn't scream, it whispered. And those whispers were enough to make professionals nervous. JP Morgan's dominance has always been tied to its ability to project stability. If that projection weakens, even temporarily, the ripple effects can be enormous. This doesn't mean the system collapses tomorrow. It means the margin for error is shrinking. It means stress is no longer theoretical. It's visible, it's measurable, and it's spreading. When the strongest institution shows signs of strain, everyone else reassesses their risk. That reassessment leads to selling, hedging, and withdrawal. Not because disaster is guaranteed, but because survival comes first. So where does this leave us? It leaves us at a turning point. A moment where markets must decide whether this panic is a warning shot or the beginning of a deeper unraveling. JP Morgan may regain control. They may stabilize flows, reassure counterparties, and restore confidence. But the fact that this question is even being asked tells you everything you need to know about how fragile the environment has become. The real story here isn't one bank. It's a system built on confidence, leverage, and speed, now being tested by reality. Monday wasn't just a bad day. It was a signal. A reminder that no institution, no matter how powerful, is immune to changing conditions. And when control slips, even briefly, the market notices. As you watch the next few days unfold, pay attention not just to prices, but to behavior. Watch liquidity, watch volatility, watch how quickly narratives change, because the biggest shifts don't announce themselves with headlines. They reveal themselves through hesitation, through silence, through moments where the usual leaders stop leading. If JP Morgan truly lost control, even for a moment, then Monday wasn't the panic. It was the beginning of awareness. And in markets, awareness is often the first step towards something much bigger.